Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London, UK feed wheat.
Paris milling wheat. In mid-November last year, the market broke down and out of the combination of the mid-September to mid-November 2023 descending triangle, as well as breaking below the neckline, highlighted in purple on my daily chart, currently at 234, the June to November 2023 head and shoulders top. This was a break all the way down to May 2023 low at 221 before a reactionary rejection back up. However, the reactionary move back up only managed to reach the area of the neckline and the lower trend line in mid-December, then failing, dropping down all the way to last week's low, just over the March 2021 low at 192 even. In the process, the market filled in a previous gap left over from when prices were originally moving up back in July 2021, between 218.5 and 219.5, and also created two new gaps, small ones, between 216.5 to 217 and between 212.75 and 213. So, to this descending triangle, I had laid out targets below some 9 weeks ago for this. Thus, the primary target was in the 227 zone, whilst the harder to reach secondary target was in the 220 zone. These have both been achieved. Next, we'll look at the larger head and shoulders top pattern. I've been frank 9 weeks ago when I stated, and I quote, I am not necessarily comfortable with the head and shoulders pattern, but I still feel obliged to indicate potential for this pattern below. Thus, a primary target X2 is in the 215 zone, with a secondary hard to reach target X3 down below the bottom of my daily chart in the 197 zone. End of quote. Both these two targets, harder to reach or not, have been achieved. Last week, after achieving the secondary target, the market made a seeming pipe bottom and prices have turned higher. This leaves me with one big picture item that I will bring to your attention once again. So, as part of this move low, I'd like to once again discuss the previously mentioned big bear channel, currently 234 to well off the bottom of my daily chart. This bear channel is highlighted in dark blue on my daily chart and originates from June and October 2022. It's coming up to 2 years ago. It is right and appropriate to consider this big picture item in the light of what we've recently seen. There is one new final item I'd like to show, one that is not satisfactory, but one I'll still bring to your attention. It is the early November to mid-December 2023 bearish Andrews pitchfork. It's far from perfect, but it has shown a strong inclination to hang around a declining upper time, highlighted in bright red on my daily chart, and that's currently at 197. I'll say no more on this other than I'm looking forward to retiring it soon, unless it keeps doing what it's doing at the moment, which is showing the bearish angle of attack of this market. If not within it, then along the upper time. Minneapolis wheat. Now, compared to Chicago wheat and Kansas City wheat, Minneapolis wheat had usually been somewhat easier to read in the past with respect to what was going on and what the opportunities might be. For a while, this seemed no longer true, but recent action seems to have brought the market back into clearer line. So, back in late February 2023, and especially at the start of April last year, so that is now outside the parameters of my daily chart, the market constructed a large bear channel that morphed into what we now see highlighted in dark blue on my daily chart. A descending, expanding wedge pattern, currently 765 down to well off the bottom of my daily chart. The upper trend line had been escorted and reinforced in the past, well, sort of, by the declining medium moving average, currently 721, which, when combined together, helped cap the market last year. However, in mid-July 2023, the attempts higher resulted in a clear break above the upper trend line, and also the important declining long moving average, currently at 773. Prices climbed rapidly during July, up to the 50% Fibonacci line of the significant August 2020 to May 2022 move at 955, where the rally was capped and prices turned back down. It is this turn back down that has captured my attention. All the while, as the market had, since late July till mid-September last year, formed a descending scallop pattern. Yet not only that, but since mid-September 2023, the market formed the crucial ski jump of this descending scallop pattern. And from the start of October last year, it started its subsequent journey lower to potential targets below for such a pattern. Thus, we had a primary target below in the 708 zone, with a secondary hard-to-reach target down in the 689 zone. In mid-January this year, the market punched down through the 737 to 724 congestion zone, as well as the next congestion below, between 693 and 708, eventually reaching the primary target. For a while, the market did revert back up in late 2023, but the overhead declining short-medium moving average, highlighted in dark green on my daily chart, capped prices throughout December 2023 and into January this year. In truth, this moving average had been an effective cap on the market since mid-October 2023. Not tested, but effective nonetheless. At the end of December last year, prices gave up testing the overhead short-medium moving average and headed lower, reaching the secondary target for the descending scallop pattern. A second attempt lower properly punched through the support between 693 to 708, dropping down to the August 2018 high at 650 and the January to March 2021 congestion zone. Yes, something that's from 3 years ago. A congestion zone between 625 to 650 even, which is where we are just above or just below or just within now. This also fits in with 3 other patterns I've spotted nestling in like Russian dolls, one within another. 16 weeks ago, I said the following of the first pattern, I quote, "It is the nascent late August to date bear channel highlighted in bright red on my daily chart." And that's currently 600 to 722. This pattern is still operational. Once again, I note how we have a smaller bear pattern nestled within a larger one, much like a Russian doll. And that's the end of the quote. Today, this pattern is still alive, though we've not really had any tests below or above. The next one is highlighted in purple and is the October 2023 to date bear channel, currently 642 to 718. This one has seen some touches and the market is not too far away from the lower trend line, currently at 642. The final one is the most recent and is the late December 2023 to late January 2024 bearish shift pitchfork, a pitchfork inspired by Chicago wheat. Last week, prices punched down through the lower tine, highlighted in bright green at 653, but smartly turned back up, though we are again testing and crawling on the top side and punching below the lower tine right now. All these patterns are bearish and they give varying opportunities depending on what time horizon you might be interested in. For the moment, keep an eye on that 3-year-old congestion below between 650 to 625. London UK feed wheat. The move higher from the May to July 2023 double bottom pattern reached its climax in mid to late July last year. Since then, prices have moved lower and eventually sideways and most recently lower again. The short medium moving average, currently at 175.10, had tried, not wholly successfully, to act as a sort of a cap on any rises, and the medium moving average, currently 180.10, moved away from being a market attractor to being a slightly distant cap on any of the late last year's attempts higher. Interestingly, one of the key features here, and it is a surprising feature, has been the neckline, highlighted in dark blue on my daily chart, currently 188.15. And that's of the May to June reverse head and shoulders bottom, acting first as a pretty reasonable support, and now as an additional resistance. Though I suspect in the background, the September 2021 lower 181.70, and perhaps more importantly, the 50% absolute Fibonacci line at 180.5, had helped in the past to prop up prices, and now this year to cap prices instead. In the bigger picture, last time I spoke, there has been no significant, I said there was no significant pattern development being undertaken, apart from the previously mentioned neckline. This was a little disappointing and actually unsurprising, all at the same time, and the market seemed reasonably happy to travel sideways to ever so slightly higher, around, along and on top of the neckline, and towards the greater bearish pressure of the declining medium and long moving average. Long moving average currently 183.65, coming in from above. The situation obviously was not designed to last, and at the start to the middle of the year of January, we saw prices fall through the support, and then 4 weeks ago make a weekly key reversal down to confirm the bearishness. Prices have exploited this bearish pattern ever since. So what lies in wait below? Well, we have the May 2020 low at 149.95, the April 2020 low at 148.45, and the March 2020 and 2020 as a whole low at 145.45. This one is more interesting, this last one, as this is within an old piece of congestion dating from between 2016 to 2018, between 147.75 and 136. There is also congestion above between 161.95 to 165.75, though how good that is may be debatable, as prices sliced down straight through it within a week earlier in February.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.